In today's video, I'm going to be looking at the anti-competition laws in the EU and the US around big tech. Hello and welcome to another ACY Securities Hot Topics video. My name is Alistair Schultz and I'm going to be your host through today's trading journey. The first thing I'm looking at today is the EU side of this, the European Union. They are all wanting to take on big tech at the moment, but the EU has probably got the harshest restrictions coming in place. Now, right now, the new legislation is aimed at bad behavior, particularly in big tech companies who might be using their power to their advantage. So, companies like Apple, Google, Amazon, and Facebook are where their points of interest really are. At this point, existing fines and antitrust measures have been ineffective. We heard a couple of them where they saw $9 billion in fines and they kind of just shrugged it all off. So now they're looking at the extreme side. And the extreme side of this is that they will put in place legislation that will enable them, if they don't behave, and they don't follow suit on the legislation, that they can actually pull apart the company and subsidize it into separate segments of itself. In which case, if you're a company like Alphabet, that would mean that Google, YouTube, and of course any of the other privatized sides of it will be separated, meaning you can't actually work together anymore as one conglomerate. Now, that is a big impact, but at this point in time, stocks have been like, yeah, whatever. Purely because they've tried this before, we've had a good read down on what's gone on with it. It's just a matter of how far they can really go with it. This is likely to take some time, and it's not going to impact investors immediately. So that is something to consider down the track. Now, the other side of this is that the US has actually gone after Google on their own. They are suing Google. Previously, when all the EU legislation stuff on anti-trust laws were coming in, we saw that the US was really critical of the European Union about why they were targeting US businesses. But now the US Justice Department is suing Alphabet. Now, the same of the reasons really being cited from what we hear in the EU, an abuse of power that is related to antitrust problems and anti-competition. And what they're allegedly saying is that they've frozen out a competitor or two along the way of their growth to where they're sitting at now. And of course, that's not something unheard of. We've heard of this sort of behavior happening at Facebook and Amazon. Perfect example would be Facebook and Instagram. Amazon with babiesrus.com or the nappies.com place tune for baby goods. So, it's not the first time we've seen this sort of behavior, and it really is sort of freezing out some parts of the market. New entrants are unable to really get started because they're competing with such low prices. And of course, if someone does get up to the competition standard, then it simply gets bought out and all beaten down until they have no choice but to sell. So there are a number of issues that are surrounding this, whether they can actually get an effective piece of legislation that will help stop them. And of course, in the US's case, where they're trying to sue. We'll have to see how this all transpires. Now, of course, again, there's not been any hit. The Google stock, Alphabet stock has really just shrugged it all off at the moment. So it'll wait and see until we actually do get some more concrete data about what's going to happen next. Now, the next one I'm looking at today is on Netflix. Subscribers have missed the mark entirely. Revenue, though, was on point. It was actually a little bit above, 0.6 above the expectation of $6.44 billion in total dollars. Now, of course, that's a pretty good number, and you would look at that and go, well, that's, we can't really complain about that. But what we can complain about is how many subscriber additions they actually had. Their target range was for 3.57 million, and they've managed to make 2.2 million new additional subscribers. Now, that's problematic because you're in a company that is based on subscriber figures. They have subscription services, they make their money and their revenue all derived from subscriptions. So if your growth targets on subscribers don't match, then you are expected to probably not get the amount of revenue that you want in the future. One good thing about subscription models are that they make it much easier to forecast on these fronts. Now, the other side was their earnings per share. They reported a $1.74 earning per share when really the target range for it was at $2.14. So that's also fallen over, meaning they haven't made as much as you would hope to for each of their shareholders. Of course, this has resulted in a 6% stock drop. So even though their revenues were up, just because those subscriber numbers are down, we've seen a drop in Netflix's share price overall. Now, investors are starting to cast doubts. More doubts about their ability to run with sustainable growth, but also about competition. So you've got two factors here that are highly important to Netflix directly. You've got a lot of new companies or streaming services entering the market, which seems like almost on a monthly basis to me. And you've also got this question about, okay, well, you've seen very good numbers earlier in the year, but now those numbers are starting to trickle down as people either run out of money or they go back to work. Either way, it's a situation that makes us question about the economic recovery. Are we seeing recovery on consumer numbers, or are we seeing people run out of cash? My likelihood guess, considering we're seeing what's going on with employment situations around the world, is that people are starting to run out of money, not go back to work. Now, moving on from Netflix, I'm also thinking about stimulus today. We have seen every day for the last sort of week or two, basically a ping pong game. Last week, it was all about Trump saying yes, no, yes, no. This week, it's basically been between Nancy Pelosi and, of course, Steve Mnuchin and the Republicans and the GOP senators. So that has caused us a little bit of problems. Now, today, what we've heard is Nancy Pelosi and Steve Mnuchin are feeling quite confident that they will be able to reach a deal of some kind. Both are reporting that gap between their numbers that they're sort of talking about is closing, and hopefully that means we will see some money coming in, but I'm still not liking my chances for it coming in before November 3rd for the election. I feel that it would be optimistic to see that. Of course, it doesn't mean my hopes are all but drowned for it coming out before January of 2021. So I'd keep that in mind. Of course, the deadline date that we saw yesterday from Pelosi seems to have let investors just sort of shrug it off or slide it away. Now, really, at this point in time, Pelosi is seeking roughly a $2 trillion relief package. And of course, GOP senators are actually looking for something a quarter of that size. So you can see where there's a big numbered miss. There's $1.5 trillion difference between what they're asking. So how close that agreement really is, or how close they are to a deal, means one person here or one team on one side is going to be missing the mark by a long way. So we're going to have to keep an eye on this situation. Naturally, it's going to affect the US dollar. It's going to affect US stocks. This is a big deal. So far, we've seen $3 trillion of stimulus getting pushed through from a fiscal side of things. So this is likely to have a big impact, especially if it's on the $2 trillion side. Now, in the news ahead of today, there is a little bit going on. Nothing's huge or major impact, but when it comes to the New Zealand credit cards spending side of things, I think that's an important figure. The reason being is that people have been paying off a lot of debt throughout the pandemic, and that is indicative of people wanting to pay down what they owe so that they have less outgoings later down the track. And this usually means that if we see low spending numbers on credit cards, it means people are not wanting to use their credit card, and we're likely not getting a huge amount of consumer spending either. Now, looking further beyond that, we're also going to be seeing CPI, PPI, RPI, and HPI out of the UK today, as well as hearing from the Monetary Policy Committee member Ramsden out of the Bank of England. From there, we've got retail sales out of Canada, something to keep a brief eye over as well. And then later in the US session tonight, we'll be hearing from both members from the FOMC, Brainard and Mester, about an hour apart for both of them. Of course, if there's anything from today's video you want to reach out and get in touch with me about, you're welcome to hit me up on any of my socials or to email me at talk2al@acy.com. Of course, don't forget to like and subscribe to this video so you can get more great content from me and ACY Securities in the future. Have a great trading day ahead.